What's up, traders? I've quite literally got a midnight special for you today as we head into what could easily become the most important trading week of 2023 thus far. The main concern is the Fed rate hike decision on Wednesday at 2 p.m. and the press conference to follow from Jerome Powell at 2:30. Sprinkled around that, we've got the continuation of earnings season with Apple, Amazon, and Google reporting this week from our watch list. It's the perfect recipe for some major stock market volatility. Let's kick things off here on the SPY weekly time frame chart and jump into our structure and location. No fancy intros or transitions on the midnight special. What do we see here? Certainly a solid bodied green bar with very minimal upper wick and very minimal lower wick as well, especially in relationship to the size of the candle body. We've also got a strong close up towards the highs of the weekly range, so structure here definitely goes towards the buyers. If we think about location on the bar to bar count, we've got ourselves a higher low as well as a higher high, another bullish data point there. And because everybody's been watching underneath a finely tuned microscope, you should know that, of course, we have a break of our weekly resistance trendline, which does in fact increase the odds of bullish outcomes as we move forward. However, what it does not do is confirm a weekly trend reversal. Yeah, that's right, I said it. It does not confirm a weekly trend reversal. If we think about this from a trend count perspective, we have lows, we have higher lows, we have highs, we only have equal highs. To confirm a new weekly uptrend, we would have had to produce some sort of higher high over this area here, which is SPY 410. So we're continuing to monitor for that upward move, and it very well could happen in the coming weeks worth of trade. But as of right now, we have to at least be open to the idea that sure, there could be some opportunity for a double top here. But I would just remind you that double tops really don't get all that bearish until we actually take out the neckline of that pattern and confirm a new lower low. It's all about trend counts, right? So this would be a low, taking out the neckline produces some sort of lower low, and we can look for the bearish outcomes. And if we remember our market history, we can go back to 2002. The final leg of the dot-com burst comes from a double top under very similar circumstances. There's the trend line, there's your low, there's your higher low, there's the break of the trend line, there is your equal high. Notice that the waterfall sell-off here, so to speak, does not really start accelerating until we crack underneath the neckline of that pattern. It requires a lower high, and then the sellers really take hold there. It's not a guarantee that something similar will take place in 2023, but it does speak to the way that patterns unfold and searching for that breakdown of 380 if you're a seller looking for this to turn into a double top. Now, if we do pull back, it's not the end of the world, and the perfect place for a higher low pullback would be roughly SPY 390 on the weekly time frame chart. We know this to be the major level that we've been watching over what feels like the past year and a half. It's only been about, maybe half a year in total. But 390 is a structural area. And also, if we take a look at our volume profile chart, we know it represents the high volume node here as well. So pulling back to find a higher low and bouncing for another equal high starts to set up an ascending triangle pattern where, of course, we're looking for bullish outcomes over the top of that pattern, which again would be right around SPY 410. Now, if we do break out and see continuation, what's the next volume target? It's 420. Right? So if we do just see continuation, that of course would imply a break of 410 anyways in the upward direction. Being in the midpoint of the low volume void, remember that the market doesn't really like it here. It's most comfortable where it can find high pockets of liquidity, which would be your high volume nodes. So the market should be drawn towards 390 or push higher up towards 420 in the coming weeks worth of trade. Let's move to the monthly time frame chart just because we only have 2 days left in the month of January. Of course, there's plenty of activity that could happen on Monday and Tuesday, but just generally looking at this chart, we know that this level here represents a neckline of an inverted head and shoulders type pattern here, and lo and behold, that level is also SPY 410. So if we break SPY 410, not only is it producing a weekly higher high, it's also breaking an inverted head and shoulders neckline on the monthly chart, and the suggested measured move from this perspective would bring us just shy of the all-time high. Once again, this is not a suggestion that we're going here in the coming weeks worth of trade. It just suggests more bullish outcomes as we move forward over SPY 410. If we reject SPY 410, then you know the deal. It's not as bullish as it could have possibly been. Let's move on down to the daily time frame chart and just quickly assess the expected move, levels, psychology, some things that took place last week. We'll keep it brief on the midnight special. Here's the weekly expected move. A lot of questions about the expected move recently in the comments section, so here's a tutorial in the top right-hand corner on how to figure out these numbers. The upper edge is 415 on our SPY, and if we're contained by that, that would of course imply breaking 410 and also producing a daily higher high. If we pull back to the lower edge of the expected move here, which is roughly 396.30, it would imply a higher low pullback. If we think about the trend count on the daily time frame, from here we've got low, higher low, higher low, and most importantly is tracking the highs. We've got highs, higher highs, higher highs, and a higher high as of Friday. So noting that we just finished off with a higher high, we could afford some sort of higher low pullback, and the lower edge of the weekly expected move would seem like a perfect higher low pullback above 390, 350, and keeping us well inside of the prior balance area from here as well. Now, in terms of psychology of what's been taking place here, I'm really impressed with the buyers, and the failure from the sellers, to be quite honest with you, continues into the latter stages of last week's worth of trade. We talked about Wednesday's gap down, the failure from the sellers here, the fact that we closed strong at the highs. That's great. We gap up on Thursday. The sellers actually push lower. Let's see this on the hourly time frame chart. It's very ironic what took place. If you're a stock market bear, this should be a big red flag to you. Notice that we close the gap and bounce. We do not recapture the opening print on the very next hourly bar. The sellers actually undercut the low of the day's session. They push into the prior day's range here, as represented by this little lower wick, but it's an absolute failure. There is no movement inside of the prior day's range. There's no close inside the prior day's range, and the buyers run away with it into the close. We know the rest is history for Friday as well. I mean, liquidation break never violates the opening print. The pullback here, where does it stop? Right at the highs where the first liquidation break took place. So I'm not seeing the evidence of stronger sellers existing yet out there in our market. Now, don't get me wrong, because we do have the upper wick and inverted hammer from Friday, I think some scenarios to be thinking about would be a pullback earlier on in the coming week, right? We know that Powell is probably not too happy with the loosening of financial conditions, so to speak, and it'll probably come out as a hawk on Wednesday. We don't want to sort of bet the farm on that until it actually happens. We want to react to that. But seeing the inverted hammer here would suggest that taking out the low underneath 403.50 could produce a pullback to easily backtest the breakout point here at $400.75. From there, that's where the questions arise. I mean, rainbows and butterflies for the buyers is just consolidation above, and maybe we break into the end of the week or early next week to get up towards that 415 area. And we know that the weekly high volume node target overhead is also a gap on the daily time frame chart closer to 420. The gap is over 419.50, closes at 421.25. So that's the rainbows and butterflies situation. Would be a very, very mild minor pullback to retest the breakout point here. You get break, retest, and rally. That's what the bulls want to see. Even deeper than that, it's okay for the buyers as long as we find some sort of support over 390, 350. We would be fine from a daily trend perspective, building out some sort of higher lows along a rough trend line like that. So 390, 350 is a line in the sand. And from the weekly perspective, we know that the line in the sand is 390. The sellers, if they are going to be aggressive, if something serious is going to happen in the downward direction, sellers need to take out 389.50, 390, the weekly high volume node. And nothing about this chart currently would suggest that that is the case. And we'll look at more evidence for that in just a moment. But before we do so, let me share a couple of Fibonacci perspectives and then our anchored VWAP. So from low to high of this move, notice that the 38.2 is roughly coinciding with the lower edge of the weekly expected move. That would preserve bull flag consolidation, looking for continuation in the upward direction. And your 61.8, a line in the sand from a Fibonacci perspective, is also correlated beautifully with the high volume node. So this, of course, reiterated as a line in the sand must hold area if the buyers are going to hold the market sideways, right? Ideally, buyers hold up over 390, 350 that we were just discussing. And then the last one I want to share with you is something we haven't looked at in quite some time. Would be from the low of 2022 up to the most recent high that we have up here. The 38.2 is also right around this area. So if this is going to remain in bull flag consolidation, we want to stay above that 38.2, which once again is correlated quite nicely, with that weekly high volume node area around 389.50. So staying above this is really the key to bullish outcomes in the market going forward. But we know from a more nuanced perspective, if you're a trader looking to take advantage of this micro uptrend that we have here, of course, higher low pullbacks that respect the levels we've just discussed are more optimal. Let's have a brief look at our market internals and see what's going on from this perspective. In last week's worth of trade, there were definitely inflows, but remember that we want to see about 1 billion here for it to be considered significant or very bullish. And you'll also notice that we had some neutral days here, some recovery days, nothing that really got up and over 300 million. So inflows were there, but things are definitely slowing down, which sort of pairs nicely with the fact that we should expect some sort of pullback here off of the higher high in our market. Same thing with the advanced decline line. We never really got any trend days that were just stuck up here in the trend zone over 1500. Notice it requires quite a bit of recovery here, quite a bit of recovery here, pullback, recovery here. Same thing with the cumulative builds. This is a strong build. I will say that Monday's build was actually quite solid, but look at what we got into the remainder of the week, hardly scratching at over 3,000 in the tick cumulative build. And what I want to focus on is the liquidation break from Friday as well. Notice as we sell here, we actually hold the zero line, we recover from the zero line here. If we look at the ticks, we never actually build out a major negative build in the cumulative read. So once again, this would just suggest that new money sellers aren't really getting active in the market. This is longs with poor location closing out, and then of course new money longs entering here on the pullback or what have you. It's not aggressive selling is the point of looking at the market internals from this perspective. So once again, a pullback could unfold, but we're not expecting any major market selling unless, number one, internals deteriorate, or number two, we actually start to violate that weekly structure we were just pointing out around SPY 390. Let's have a brief look at our market profile. Some learnings from the profile here. If you don't know what this is, top right-hand corner's got you covered with a brief tutorial. The value area was actually central in Friday's distribution instead of skewed up towards the upper edge, which would, of course, just have been a little bit more bullish. Same thing with the point of control. It's not higher with price. It's literally in the midpoint of the range. What else can we say about this? We do technically have decent excess at the highs and lows. If I just zoom in a little bit on this, we have a couple ticks of excess at the highs in L period, a couple ticks of excess in A period on the lows. What I will say is that we have a poor low from Thursday, and if the market does pull back, that would be an area where we could see the market return to repair the structure. And lo and behold, what would that correlate to? Kind of the rainbows and butterflies situation we just discussed on the SPY daily time frame chart, retesting the breakout area on the daily, right? This was kind of the 3-bar highs, break and continuation on Friday. Repairing Thursday's low would be a pullback to test that area and then looking for a move back higher off of that repair. So something to carry forward here in the ES would just be our poor low from Thursday's session. Let's have a look at our sectors and go back on over to the Thinkorswim platform. And what we'll do is just go here. So everything's nice and pretty great. So weekly performance. Notice that the XLY is outperforming XLC, XLK, all the outperformers for the week. At the bottom of the barrel, we see the XLV, XLU, XLE, all of the risk off or lightweight sectors. XLV is a heavyweight sector. There's some confusion about that one. I'll clear it up when we get to that structural chart. Looking at the XLY, I mean, very, very hard to say that this is a bearish chart. Big recovery, back up at the top of the range, threatening a break of the top of it. 148 is the number. I would expect a reasonable higher low pullback as long as we're above 142.50 roughly. Above this gap area in here, this chart is bullish. Being a market leader, being a risk-on sector, this strikes me as being a very positive look for our market currently. Let's have a look at the XLC, same idea. I mean, the chart is hardly recognizable when we were looking at it in this range down here. We're well outside of the range. We've closed this gap overhead. Once again, I would recommend that a higher low pullback would not be out of the picture. And as long as we find a higher low over the top of the range above 52.17, this is a bullish data point for our market. XLK, what do we see over here? Once again, there's the range. Above the top of the range, higher lows, rainbows and butterflies is over 135. Wouldn't be the end of the world if we found a pullback that's even as low as 132.50. Big improvements in all of these three heavyweight risk on sectors. Let's take a look at the real estate sector up next in our lineup. An impressive break over the top here. Lightweight sector for the market doesn't mean a whole lot, but certainly has much more to do with the wealth effect. This is a positive move for real estate and the way people feel about their net worth. XLF, right? Look at this. I mean, very hard to say that this is not a weekly or even monthly ascending triangle. That is a bullish pattern. If I've ever seen one with lows, higher lows, all of these equal highs forming a pressure cooker top, breakout over 36, which has actually already taken place. We're just looking for continuation, is a bullish look for our market. Carry that forward because the ratio grid is actually lagging just because these have been outperforming so much. I mean, a wild 6.13% on the XLY on Friday. That's unheard of, right? So XLF, the structure is bullish, but we'll see on the ratio grid in just a moment that it could use a little bit of help there. XLI, monthly bull flag, weekly bull flag, whatever you want to call it. It does look good on the higher time frames, but in the shorter term time frames, this unfortunately is still stuck in a range. It's kind of sideways towards the midpoint of that range. I would not be overly aggressive in industrials for the coming week's worth of trade, but it's also not bearish. Let's be very clear about that. This is not a bearish chart here. Next up is materials, XLB. Same idea, kind of building out that bull flag, more consolidation up here towards the highs. We've been talking about the cup and handle formations. We've been talking about the higher lows and looking for those breaks for next higher highs. XLB, lightweight sector, is not going to mean a whole lot for our market, but the structure structure here is certainly bullish. XLP, consumer staples. What's going on with the staples? Definitely a D for defensive risk off sector. Notice that it's completely different than almost everything we've seen thus far. It's putting in bear flag consolidations. It's in a short-term downtrend with lower highs in place and lower lows as well. We don't want it falling off of a cliff. We don't want it going to zero, but we certainly do want it lagging the market, and that's exactly what it's doing. This does strike me as being A-OK for our S&P 500. XLE for energy, certainly setting up a longer time frame pattern, bullish pattern that is, with an ascending triangle, very similar to something like the XLF possibly. This, unfortunately, is a D for defensive sector. We want to see it lag, so I'd prefer not to see energy break out over 93.25. It may look like we're headed towards all-time highs, but we are not. 2014, I believe, was the time that these highs were set, but you have 98.25 as resistance, and 101.30 is roughly your all-time high in the XLE energy sector. I would prefer that this plays nicely in this overall range here and perhaps gives us a pullback to 87.54. Market never gives us exactly what we want to see, but that would be preferred. From a technical setup and structural perspective, yeah, it definitely looks a little bit more bullish than bearish, finding a higher low inside bar above this little micro range right here as of Friday's pullback. So consolidation here and a break certainly could be on the table for energy, but I would prefer that it didn't happen, of course. Anyways, XLV, this is where the confusion is. Let's be very, very clear about the XLV. This is the second heaviest weighted sector by market cap. Therefore, if the S&P 500 is going to find a rally in the upward direction, it's very important that the XLV participates in that upward action. However, if you think about XLV from a fundamental perspective, it of course is a risk-off defensive sector. Why is that? Well, of course, no matter what the economic conditions are, people will always need healthcare. It doesn't matter if the market's falling off of a cliff, grandma who needs 32 pills a day to, make it through the day is going to need those pills. Therefore, the healthcare sector will not outperform, but will be a performer regardless of market environment. So that's the difference between the two. The sentiment is risk off, but because of the weighting in the S&P 500, it needs to participate or at least not be falling off of a cliff if the market's going to have more bullish outcomes. Hopefully that clears it up. I'll continue to try to reiterate it when I can, but this chart is slightly concerning. Notice that we've got a balance area here. We had the look below and fail that failed once. We had the look below and fail that failed twice. And now we're expecting kind of lower here, which would stack up as a bearish data point for our S&P 500. If this pulls back, we do want to see 130.50 hold as support. Maybe that's just enough of a mild pullback to give us that mild pullback in the SPY itself. But if we break this, there's thin structure here. That would be a concerning look underneath 130.50 in your XLV. So this is certainly something to be keeping an eye on into the coming weeks worth of trade, the healthcare sector. Next up, XLU utilities. Last but certainly not least, lightweight and D for defensive. No confusion about this one. Just like the XLP, love the fact that we're putting in bear flag consolidation, kind of hanging out sideways here. We're not outperforming over these highs. We have highs, lower highs, lower highs. We've got lows, lower lows, lower lows. Short-term downtrend, not outperforming the market, strikes me as A-OK, exactly what we want to see from the utilities here. Let's have a look at the ratio grid now, and this is where I was discussing that we have a little bit of mix-up in terms of what's happening with the XLF, but top four are the risk on sectors. Notice the big improvements in the XLK. That strikes me as bullish. XLV falling off of a cliff here, but as we just described, it's not the end of the world as long as the structural chart does not break down underneath that 130.50 area. The XLF is where I want to say that, sure, we've technically got the lower high here. We've got the higher low here. Because of the monthly or even weekly ascending triangle on the structural chart of XLF, if that breaks out, I would imagine that this ratio perks right back up, which would of course be more indicative of risk on. If it doesn't, then hey, we'll take it at face value and say, all right, maybe we've got to pause on our aggression for the risk on perspective in the market. The XLY though, clear as day. Look at the massive parabolic curl there in the XLY ratio. Very, very indicative of risk on. A very bullish look here, and certainly more meaningful in terms of this was at first just a counter trend move. Now that we're well above a descending 50 SMA, strikes me as being a big improvement and perhaps the beginning of a new uptrend in the XLY ratio. The bottom four are the risk off sectors. Notice that all of them are plummeting, falling off of a cliff in staples, utilities, energy is sideways. Real estate's slightly higher, but again, has much more to do with the wealth effect. And one that does get an honorable mention is the XLC, a risk on sector. Communications definitely looking solid there in the ratio grid. Let's have a look at the XLY over the XLP. This, of course, is growth versus value. And just like the XLY itself, massive outperformance there. Once again, I mean, nothing more to say than this is an absolute ripper. It's much more than a counter trend rally at this point in time. It seems significant, and it definitely seems more risk on. Let's have a look at our dollar. So going on over to the Dixie, what you'll notice here is we've got a lower dollar that's kind of hanging out in that falling wedge, which as we know is a bullish pattern. We're looking for the back test of 103.50 on the dollar, which is being confirmed by the gold contract, right? If we look at gold and take a quick zoom in, I apologize for not zooming in on the dollar, but if we look at this pattern, right, this is not ascending, but this is a rising wedge, bearish pattern, looking for the breakdown. Now, the overall trend will not change if we find a higher low anywhere over 1820, but it would suggest that the dollar could potentially move higher, which is bearish for equities, as we know. And I think that the dollar and gold specifically are waiting. They'll be hanging out in limbo ahead of the FOMC announcement, so watch out for that on Wednesday. Speaking of FOMC, let's take a look at our interest rates via the TNX. What's going on over here? Once again, kind of holding its breath, going sideways, but overall the idea continues to be weekly lower high, equal lows here, descending triangle. A breakdown of 34 would be bullish for our market. You're going to continue to watch and see what happens on Wednesday when Jerome Powell ultimately hops on the mic. Let's move on over to the Fed Watch tool. Actually, first of all, here's the calendar, right? So for those who didn't know, 2 p.m. is the statement. We'll get the Fed funds rate, and 2:30 is when Jerome Powell hops on the mic. What's very interesting about this is same day we'll be getting the manufacturing PMI, which of course the Fed knows already. ADP non-farm is that morning as well. And we're also in the end of the week going to be getting hourly earnings, non-farm, the true number, as well as unemployment, and then ISM services PMI later on that morning. So a stacked week in terms of fundamental data out there. But the Fed Watch tool, very interesting here. Notice that we are pricing in still that 25 basis point rate hike to get us to the 500 terminal. And then from there, we're expecting a hold. What's interesting is that we did price in prior episodes another cut in the latter half of 2023. That's not the case as of right now. Continuing to check in on the earnings data. Notice over on this screen, we've got a 62% beat rate, which is just shy of the typical 66% beat rate for a normal market environment. But as we know, it's really all about forward guidance. So here's an updated screenshot from FactSet on the number of companies issuing negative guidance for Q1. It's above the 10-year average. You can see right here, the current amount is 89%, 17 out of 19 companies, which I totally understand, very small sample size. I will concede that point. It's above the 5-year average of 59% and the 10-year average of 67%, guiding negative in the forward quarters. So with that being said, it doesn't look great from an evaluation perspective, but if the market's going to rally, we better stick to the data that the SPY is showing us if we're a trader. There's also been some confusion around the channel between investing mindset and trading mindset. If the SPY is moving higher, we're not going to argue with that. We might be skeptical because of the fundamental narrative, but it doesn't mean that we're just all of a sudden going to short the SPY into a hole if we're a short duration time frame trader. So again, some confusion on that. I just want to be very clear about the intentions of this channel. Here are the earnings that are coming out in the coming weeks worth of trade. Once again, an absolutely stacked week. I'm not going to go through every single one of them, but the major ones on our watch list really reside right here. Thursday after the close, we get Amazon, Apple, and Google. Of course, plenty of other tech companies sprinkled in there, some industrials as well as consumer staples. Really important week for earnings nonetheless. So keep an eye out for some of these major companies that are reporting. Let's go back on over to the platform though and round out some of our expectations for the market. Is there a defensive trade going on right now? The sectors would certainly say no, and the TLT would confirm that as well. Here is your relative strength line, a ratio basically to the SPY. It's completely flat. We're not seeing a flight to safety in our bonds. What about the HYG? Has the risk appetite of our market? It's staying elevated, right? The SPY actually caught up. This was calling the bluff, right? It was saying, hey, risk on, as the SPY was lagging. The SPY has finally caught up and we're going sideways in the HYG. Strong risk appetite. It is slowing down though and going sideways, probably again holding its breath ahead of the FOMC announcement. And if we take a look at the Bitcoin chart, which once again is more indicative of risk sentiment, notice that we are above the breakdown candle high. right? So to me, that's indicative of risk appetite in the market, not so much defensive posturing, right? If the market was going to get crushed, if nobody had any spare money to go throwing around, Bitcoin would continue to just dribble lower over time. Not the case currently, seeing what's going on in this chart. Let's take a look at some market breadth indications. First one is going to be new highs versus new lows. Want to bring this one back up because we talked about the threat to a move underneath the zero line not happening back up towards these highs. Some of the best reads we've seen in over a year here. Next up, we're going to take a look at our SPX A200R companies over their 200 SMA in the SPY. Notice that this made a new high, so improvements there, spending more time above the 50% mark. Definitely bullish for our market. Hard to have a bear market if more companies are above the 200 SMA as opposed to under. Same thing in the SPX A50R. This is companies over the 50 SMA, of course. And what I want to point out is the fact that it's actually going sideways here as a bullish indication. It's not technically overbought where we get contrarian up towards this 0.9 area on our chart. And then, again, the more time it spends over the 50% mark, the more bullish it is across the breadth of the companies that make up the S&P 500. Let's take a look at the equal weight, the RSP here. And this is speaking to market leadership, right? So this actually broke out over those highs. That's why I wanted to bring it up in today's video. Once again, a couple of bad apples might be keeping the SPX underneath the breakout level here. But if everything was equal weight, things are actually much better under the hood than you may expect. Let's have a look at volatility, what's going on with our VIX. Having a quick peek over here. Once again, floored underneath 2050, new lows on Friday's session, the lowest we've been in quite literally over a year. Very, very indicative of people being comfortable with this as a rally that's starting to unfold. This as a bottom that is secure, right? If they were not so comfortable with that, the VIX would be elevated. We would be trading up in here like we were throughout the majority of 2022. Simply not the case as of what we see here. Now, of course, that does open us up to the flood effect, and we can see that as reflected in the VVIX. The volatility of the volatility index is floored down here towards the lows. And yeah, if Jerome Powell comes out, gives us the 100 basis point rate hike, you better believe that this is going higher, VIX is spiking, and the market's probably moving lower. But as of right now, again, based on the data in hand, things are looking more bullish, more comfortable for the market, as opposed to uneasy and potential for major market breakdown. Let's also take a look at Contango versus backwardation in our futures, and then we'll move along to the QQQ. Notice that this is in a strong downtrend, once again, indicative of less risk in the present day, more risk in the future, which is exactly what money managers want to see. If that was inverted, there would be less likelihood to allocate capital. With that said, let's move on over to our QQQ. It's going to be very similar to our SPY. Notice that we actually took out the highs here in the QQQ, which is almost astonishing considering that the Qs, as we know, actually made a new closing low in December, whereas the SPY did not, right? So in relationship to, this overall range here, we were at the lows more recently in the Qs than we were in the SPY, and in the Qs, we actually took out and far exceeded the upper edge of last week's expected move and the top of the prior resistance area in here. So knowing that, again, would it be unreasonable for a pullback in the Qs? Absolutely not. What would the levels be? In a picture perfect world, we hold on to 289.75 or just the lower edge of the weekly expected move. Line in the sand, of course, is the highlighted very thick white line at 281.25. That's the weekly level of interest. You can see clear as day, prior resistance, 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 support, 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 resistance here. Now that we've broken it, we certainly want to stay above if the market is going to develop in a bullish manner. Larger gap overhead in the QQQ as compared to the SPY. That's over 303 fills up towards 308.25. And just again, on the SPY, perhaps we didn't leave the chart zoomed out enough to see it, but there's the gap on the SPY in comparison to the Qs that we just saw much larger on the QQQ right here, right? So moving along to the IWM Russell 2000 and the small caps to round out the video. I think we'll leave it at that for the midnight special here. It's very, very late. It's 1:11 a.m. My goodness, I got to get to bed so we can do the morning stream tomorrow. But what do we see here? Also over the top of the balance range here. Remembering that small caps have acted as a market leader, this cup and handle formation does strike me as being more bullish than bearish. We're watching for continuation over 188.90. We're coming off of some decent consolidation here, so the market could continue in the IWM. If it does pull back, this one doesn't really have an opportunity to offer up a higher low, really anywhere lower than 184.50. Reason being is that we've already pulled back. We've already tested the bottom of the range as support here. It wouldn't really be all that constructive to come back in and reconfirm that as support. You want to see another higher low produced, so lower edge is key, 184.50, the low from Wednesday as well, right around that area. So pullback goes to here. If we do see continuation, that's great. Pullbacks after continuation, after another higher high, want to hold the top of the range at 188.90. 90. That's going to do it for today's episode. Tune in tomorrow morning at 8:30 for the live pre-market prep. We'll go over any updates that we need to give you for tomorrow's session. I appreciate everybody tuning in for the midnight special. Those who did, of course. If you're on the West Coast, I know it's a little bit easier. Those on the East Coast, like myself, you're probably fast asleep by the time I'm finishing this recording. Anyways, once again, appreciate you being here. Thanks so much for tuning in. Thumbs up button, comment down below. It all goes a long way to support the channel. And with that being said, I wish every single one of you a green trading week.